Hello and welcome to ACNT 1331 Federal Income Tax Chapter 5 coming live to you. And we're going to be discussing deductions for and from AGI, or your adjusted gross income, also known as modified gross income. We're going to be mostly focusing on other items that we haven't already talked about. These are what is referenced as above the line deductions, which they come before itemized or standard deductions on the tax return, and also itemized in Schedule A. So, starting off, the learning objectives that we're going to have. First off, we're going to basically explain how HSA can be used for tax advantage medical care, which is an awesome thing already. We're going to describe some self-employment healthcare deductions. We're also going to explain the treatment of different types of retirement accounts, calculate itemized deductions for medical expense and tax, and apply rules for taxpayer interest deductions. We're going to determine charitable contribution deduction and describe other itemized deductions, which also includes casualty loss. Ooh, casualty. So, big thing that's happening with the new law is that the standard has raised the deductions very significantly. So the TCJA actually basically almost doubled every standard deduction. So it means less people really have to itemize. So the Schedule A they're trying to get rid of. But there is some restrictions and limitations that have happened to the itemized, which the new law brought in, which we're going to get into. And all those will actually expire in 2025 unless something else happens. Never know the government. But a likelihood of provisions expiring is unpredictable. So, in some cases, we discussed the prior law because, again, we don't know exactly what the government's design is sometimes with taxes. So, they may revert back to the old law, they may stay with the new law, they may change it to something brand new. So, as a tax accountant, I want to tell you real quick, always be up to date. Always check the IRS. Okay? So, what is health savings? That's just our first one that we're going to get into. And there are 4 types of spending plans that are out there. One is basically the healthcare flexible spending arrangements, or FSAs, which we did talk about in Chapter 2. There is the health reimbursement arrangements, the HRAs. Now these are employer funded on account, and really they're not covered as generally, so they don't affect tax income, so they're good. They're more of those like coming straight out of your wages kind of items right there. Again, some of those are good, some of those are bad. Okay, there's the MSAs, which we're not going to really talk about because they actually stopped really creating the medical savings account. Kind of went from medical savings account to the health savings account. There are still MSAs out there, but they're basically all but done. As you can see, the book even states that they finished on January 1st of 2008. So that's been now a decade that they've been finished. So we're not going to really discuss too much of those. Our main focus is the health savings account. So we are allowed certain deduction from our AGI. And this is usually any earnings and unused balances of accumulated tax-free. Then when it states that, is that basically We put the money into these savings accounts by the employer. If they have it, it's a good benefit if they do. And they come directly from our gross pay, so they don't get taxed by federal withholding or Social Security or any of those items. So if you don't use them or you pay too much, you may actually have some taxes actually involved. There is a penalty right there, which we'll get into. It's really only available if you really have a very high deductible insurance. Okay? And high deductible health insurance is basically defined as $2,700 for the family or $1,350 for self. That's your deductible right there. So if you have a high deductible, HSA is good. And the maximum out-of-pocket requirements for insurance policy must be around $13,300 for family or $6,550. So HSAs are good in a way that they help protect when we have a high deductible insurance, but that doesn't mean everybody is qualified for them, because if you don't follow those two rules, you can't get an HSA. But the contribution is limited, and it is again based on either family or self, and it must be made by April 15th of the following year. So we get basically all the way up to April. So if you're contribute to an HSA right now, you have up to April to actually still contribute to it before you file your taxes. It'll still count. It's a cool little thing right there. You got a little extra wiggle room. A lot of these special ones, HSAs, there's another one that I just can't recall right now, but some of those actually have extended contribution period. Now, annual amounts to put into the HSA used to pay any unreimbursed medical expenses. Whatever you paid in, it's for medical use only. So you want to use this as quickly as possible too. Well, not quickly as possible, but use this first. Okay? But you're only allowed to put in $6,900 for the family or $3,450 for yourself. And if you put too much in, here's the bad part, there is a tax for it. Okay? So this can be good, this can be bad. So you always want to watch the limits with an HSA. Oh, my sinuses are acting up, guys. Additional contributions are allowed for any taxpayer over age of 55 though. So, and you can't contribute once you're 65 and qualify for Medicare. Sorry, you just can't. So, you want to watch out with that. And it also shows a form right here. So let's go ahead. I like always showing all the forms. So again, always go to irs.gov. And we're going to look up which form was Form 8889, Live 8s. And this is the actual form right here. So this is the 8,889 form. And this is specifically for HSAs, where they're going to have you either checking off if you're self-only or family, and it's going to have everything that you need to know. So how much contributions did you make? Did you contribute over? Or if not, and it's going to have you go through, and it's going to actually have an employer, so you got to watch out with the employer too. And then it's going to have you figure out how much of an HSA deduction you have. It's going to go through disbursements, all that, and then look right here. This is, let me zoom in, because this shows you exactly what we watch out for. Okay? Distributions from an HSA can be taxable. This is only because we have to watch out, because again, HSAs are coming from your gross pay, so they haven't had federal withholding, Social Security, or Medicare taken from them. So we have to watch out. As you can see here, total distributions you received in 2018 from all HSAs. So we're going to go through all that first. And then you want to take distributions including on line 14A that you roll over to another HSA. Okay. Also include any excess contributions. Okay. Subtract the two lines, and then qualified medical expense paid by HSA distributions. This is where you have to watch out, and with any client, you really need to know qualified medical expenses. They better pay for some kind of medical, because if they didn't and they took the money out, it is subject to tax. And right here, it actually will have you calculate the taxable amount, and you have this exceptions of additional 20% tax. You can those basically come up around here with your deduction, but you really do get taxed an additional 20% of any distributions included on line 16 that was not subjected to it. Now, excess coverage, that will start putting down here. Excess contributions, so that's where you get here. Also include excess contributions, because that will really what gets you on the 20% tax. People forget about that. Okay, so always make sure you do medical. Do lots of medical. Okay, but never go over your limits. Okay, so back to our PowerPoint. And there's the penalty right there. Sorry about that. So distributions, again, tax-free when used to pay medical. Non-qualified distributions are subject to a 20% penalty and income tax. So they call it a penalty. It basically is a penalty. However, over 65 years old, distributions taken from non-medical expenses are subject to tax but not penalties. So being a senior, you're okay. And then you're going to see distributions reported on Form 1099-SA. So let's go check out a 1099-SA. Alright, so I've seen these quite a bit. They're not hard forms, and not 1099 that we have, but this is the 1099-SA, if you ever see one. Okay, right here, it's going to have whoever it came from, whoever had the HSA, and it's going to have their EIN. It's going to have your Social Security. It's going to show who received it, what's your address. Sometimes it even has the account number. If they have multiple HSAs, if you're a tax accountant, make sure you keep track of these account numbers so you can make sure that they give you documents for each one. Here you have your gross distribution, which is awesome. You have excess on earnings on excess contributions, so they will actually tell you how much you've gone over the limit. And then here's the fair market value on date of death. If you happen to die, well, your person that goes to next, that gets it, has to actually put in the fair market value at the time of death. And then we got some distribution codes, which I'll show in the instructions for this, so you can see what a distribution code is. And then it's always going to check these three. Now, most likely you're going to see it check HSA. We're not going to have too much MSAs around anymore. So when we look at distribution codes, it's always good to pop up the instructions, because if you ever want some extra stuff, this IRS is full of this. It's pretty cool, I will say this. But here, right here, it gives you the instructions for box 3. These are the distribution codes we use. As you can see, 1 states it as a normal distribution. 2, you may see that, and this is extra contributions. We have disability, which helps us with some exemptions. Death of distribution other than code 6, which code 6 is death distribution after year of death to a non-spouse beneficiary, so a child. And prohibited transaction. Probably did something wrong there. Don't see too many of those. But this is a way that the IRS knows exactly what's going on. And most tax software uses this just to figure out, okay, this is what happens, this is how the program's going to work too. But this is pretty cool, again, to always go through and just kind of see what it is. Okay? And then they even give you a publication, 969, which you can go, again, pop up on IRS or even Google that. Okay? It's a good one. But, I mean, overall, they're not overly complicated. But we do want to make sure we know what they are and how we actually use them. So watch out for this 20%. Gotta know these contribution limits. Okay, right there. Okay? Alright. So, how about self-employed individuals? Well, guess what? Self-employed actually get some cool stuff if they pay their own insurance. One, we typically deduct this on Schedule C as insurance, but you can actually deduct this also on your 1040. There is a spot. So, the deductions for AGI that are allowed that we can use is medical and dental insurance premiums, medical and dental insurance paid for children under the 27 years who are not dependent. So, if they're not your dependents and you decide to buy their insurance, well, I mean, you're pretty nice. Okay? Medical premiums, and then we got long-term care insurance premiums. Those are all mostly, a lot of times we're going to get into medical with the Itemized, so it's coming. But there is some insurance deductions we're going to try and do. Again, we typically, most CPAs are going to put it on Schedule C, if there's a Schedule C, which there should be. So, with this, they're also limited by certain of the following. They're not allowed in months where taxpayer is eligible to participate in employer-sponsored healthcare plan. So if they're working at a job site and they're able to participate in the employer's healthcare plan, we cannot take self-employment health insurance. So really, this is somebody that's actually there. Okay. Also can't exceed net earned income. Okay, that's one of the other limits that they put on us. And long-term care premiums are based upon taxpayer's age. And this actually says use table page 5-7. Always like how the book goes 5- something. So let me see if I can actually find it. Woo! 10B 9 9. So all this we're going to get into. So fun stuff. Alright. A. That's interest. That's 7-C, 7-5, 7-. Let's see. That's state sales tax. This book does not, their PowerPoints never line up to exactly what they go with. So let's see. 5-6, 5-6. This is medical expense, which is awesome. We're about to get into that, which I like. That's retirement, good old retirement, and more retirement. There's a lot of retirement. I'll tell you that. Alright, special rules. Here we go. We love this book. Yes, we do. There we go. Special rules. Here's the long-term care premium individual. Okay, so here's your limits right here. If you're 40 and under, you're stuck at 420. That's your limit on premiums. Up to 50, 780, 60, 1,560, 60 to 70, 4,160, and then more than 70 years of age, you get 5,200 as your limit. So as you can see, the more that you get up, the better your limit is. Alright, took me forever to find that chart, but there it is. And then the last part we got is self-employment taxpayers must net advance premium credits under the ACA, or the Affordable Care Act. That's basically what it is. Obamacare, which again, that looks like it's going to be going next year, but we still got penalties. Yes, sad if you don't pay to this year. But note right here, Schedule C is typically the one that we do general self-employment income, and for certain partnerships and LLCs, and it may generate self-employment income in itself. Self-employment health insurance deduction for taxpayers in this area requires research. When they say this is one of those little things that still you actually have to look in. You have to ask your client some questions. Again, the biggest thing right here is if they're also working at W-2, you need to watch out for this part. Okay? So, types of individual retirement accounts. There is two types that we know, and it's both IRAs. This is known as the traditional IRA that a lot of people typically get, and they do have deductions for AGI under certain conditions, which we're going to get into, and the distributions in retirement are taxable. Okay, so they do require tax. Again, they take the IRAs before your gross payment. The Roth, though, has no current deduction, so it doesn't deduct anything, but distributions in retirement are non-taxable. They are non-taxable, which is actually pretty cool. When you look at retirement plans and stuff like that, I will always suggest to go to a financial planner or one that actually works in all this, and they will tell you everything and anything about this. Okay? Our job as tax professionals is just basically look what you have and how does it work. Okay? So, with the IRAs, there is a contribution limit. Okay? So, the Roth and traditional IRA contribute limit is the lesser of 100% of earned income, or $5,500. So, if you're making W-2 wages and stuff like that, I mean, you're probably going to be over $5,500. If so, you are actually good. Okay? If it's basically you're self-employed, you have to watch out on the IRAs a little bit closer, but you want to make sure that you can prove that you had earned income of so much over 5,500 to keep 5,500. But if you have earned income less than 5,500, that's as much as you can contribute. And if you contribute more, guess what? Penalties happen. Again, more penalties. So, spouses with no earned income will be able to contribute up to 5,500 also to their IRA. So you can technically contribute more to a spouse with no earned income, but always watch out. It gets a little trickier. Okay? For 2018, taxpayers and spouses over the age of 50 can contribute to additional $1,000 per year. This is known as the catch-up provision. So you can actually contribute up to $6,500, and people take advantage of this, really, because again, if you're in your 20s or 30s, sometimes you just don't think about retirement. You're just thinking about how to make it day to day with the paycheck. So I mean, it's a little bit hard, but once we get into the older and get everything planned out, the IRS and the government goes, okay, we'll throw you a bone. Here's an extra $1,000 that you can do when you hit 50. Okay? I mean, hopefully you can do, but I would strongly suggest, just as an opinion here, to try and get a retirement plan as quickly as possible, even if it's just putting 20 bucks in. Talk to a financial planner. Really will help you out. Okay? If you're not able to make the deductible contribution, you can make non-deductible traditional IRA deduction. Okay? That's basically just, again, staying the same thing, is that we can actually make the contributions, and a lot of them can be deductible. Sometimes, like the Roth, we can put money into our IRA and it will not help us at all. Okay? On tax side and retirement side, we're good. So sometimes you gotta weigh the cost and the benefits. Okay? So again, traditional IRAs deductions is dependent on AGI. Okay? And again, this whole marriage thing. So, and are you an active participation in a qualified retirement plan? So, basically, if you're paying into a retirement plan, most likely IRS is going to go, okay, you're active. So, again, we got a couple of tables that are coming at you. So, before we get into the table, let me bring in this note. If only one spouse is in a qualified plan, which most likely when you have a W-2, it has that check for retirement plan. That basically tells you. But if only one spouse is in the qualified plan, phase out for the non-active participant spouse begins when married, filing jointly couples, adjusted gross income is greater than $189,000. So we're going to be looking at that a lot. Okay, so let's go find these tables real quick. None on that page. And here we go. So, here's for Roths up here at top. Let me see if I can. Oh, look, I can expand. Good. So, here it is for Roths. And that is that right now, single or head of household phase out range is $120,000 to $135,000, while married filing joint, as you can see, $189,000 to $199,000. Once we hit over that, there is nothing that can help. Okay. Active plan, again, status is not relevant to Roth IRA phase out calculations. Again, that's okay. Here is traditional. Again, hit the plus sign and it will actually enlarge it. So, but again, we're looking at this. Okay. So single RHRA, there's no phase out. Okay, that's not a plan participant. Right? If you are an active plan participant, you got $63,000. It starts and it's completely phased out. The deductible at $73,000. Marrying jointly, you have $101,000 where it starts, where both are active, to $121,000 when you don't get any deductions. Okay. Same thing right here. If nobody's on an active plan, there is no phase out because there is no deduction. And then see note 1. right here. This is talking about all the limits. And active participation spouse, this is their phase out, while non-active participation spouse gets this kind of phase out. So, being a non-active participating spouse with one actually helps. These non-actives are pretty cool. So, but again, you need to watch out on this. Understand what is going on with an active or non-active, because we will have basically limits on it, which is known as phase outs. Okay? So, contributing to a Roth. Roth IRAs do have a contribute max. It is reduced for all taxpayers over certain income levels. We just looked at the chart on the previous one. So, it does not matter what one spouse is active plan participant or not. When it fades out on how much we can contribute. If the taxpayer contributes to both the traditional and the Roth, the combined amount cannot exceed $5,500 because that's that limit on the tradition. Okay, it basically takes over everything. Okay, so again, these are our limits on contributions. So we get contribution limits, as always happens, that we have to watch out for that 5,500. Okay. So here's an example, because we need an example. We love examples. Owen is 42, so he's under 50. Okay, watch out. He is single and wants to contribute the maximum to his Roth IRA. His AGI equals 121,000, so his contribution will be limited per our table. Okay, so let's find our table. This was the original table. Okay, and we need to find the formula. This is conversion. We don't mind conversions. Okay, so the formula is somewhere around here. We can always pop that out. Down here, it looks like. And here's the formula. So, guaranteed, next slide has the formula. We'll just go to the next slide. Please calculate how much we can contribute to his Roth. How would that change if Owen were 62? Okay, so we're dealing with him below 50 and higher than, over 50. So, with this, okay, the denominator in itself is the calculation in the range of the phase-out amounts. So, again, they really should have this, the phase-out range, which I am trying to find for y'all. Alright. Let's see if it's over here. Roth, traditional. Alright. Because I want to make sure, because the numbers always change throughout the years. So, blah blah blah, example. Here's our example. Alright. First 6,000, his phase out range is 73,060. By the 10,000 phase out range, difference between the bottom and the top. Alright. That doesn't give me the phase out range. $120 to $135. Alright, so that's what they're doing, the range. Lord, they have some fun. So, our range right here, 15,000, 10,000. They just subtracted the two. Yay. Sometimes, it's just knowing what's going on. And they change it so many times with the calculations. Alright. So, since we're single, we have we get the $15,000. If we were marrying filing jointly, or married, you get the good old $10,000. So it's only $15,000 or $10,000. And it's going to get basically times by 5,500. If we're under 50, over 50, we get the 6,500. So let's do this. We're going to take basically 135,000, which again is the high end. So always take the high end. So high end. And you're going to subtract it by whatever the AGI is, since he's in the phase out period and limited. So he has 121,000. Difference between those is what? 14,000. Divide that by 15,000. Okay, and then times that rate by 5,500, and we find out that he can only contribute up to 5,133 before any taxes could be involved. Same here when he's over 50. He's 62 now. So same thing's going on. 135,000 minus 121 divided by 15,000. So that part doesn't change. But remember, when they get over 50, they get that extra grand. So now he gets 6,500 that he can contribute up to. So his actual limit after that is only 6,067. So again, watch out on the phase outs. Okay, they're numerous. They tend to happen a lot, and this is a big question that a lot of tax accountants get asked. Is what is my contribute limit? Mostly a financial planner is going to know, but it's always good to know on yourself. Okay. So here's another contribution. This one brings in a 401k plan. Okay, 401k plan is known as a traditional IRA. Okay, 401k, 403b, all those fun little 400s that you hear about, and I think that even the book kind of puts it all together in a way. So traditional IRAs. So there's a lot of stuff that goes in. In fact, IRAs are actually pretty cool. I would actually tell you to look into it because you can even put a rent house into an IRA, which is kind of cool. Anyway, getting distracted. So Liza and Michael, again, interesting names, are both 41, and they file Maryland filing jointly. Liza is covered by a 401k plan at work, which means she actively participates in one, okay, and earns 96,000. Mikhail is not covered by a plan at work and earns 30,000. How much can each of them contribute to a traditional IRA? Okay, let's see how this goes. So here we go. First off, it's Maryland filing jointly, and their combined AGI is 126,000. Again, that's adding the 96 plus the 30. Their AGI does exceed the top end of the phase-out range for Maryland filing jointly for active participant spouses, basically per note 1. So, since Liza is the active plan participant and their joint income exceeds that upper limit, she may not make a deductible contribution to a traditional IRA. So, she could, however, make a 5,500 contribution to a Roth since the AGI is not. So, she can really contribute to the IRA. They make too much. That sucks. But Mikhail can make the full 5,500 traditional IRA contribution since the AGI phase out for this special one for non-active plans will not kick until 189,000. So, because the 401k plan is a separate retirement, that's another traditional one. but it's a separate one. And to open your own traditional IRA retirement plan, I mean, you can contribute, but because Liza and them make too much as married filing jointly, and she's active plan in another retirement account, basically, she is not allowed. Okay, she's not allowed, and that's just because of the range. So you gotta know these phase out ranges. Cool thing again, so we got software. We love our software, but remember back in the old days, we had to memorize all these ranges, and they kept changing the ranges. So keep an eye on that. Okay, so we can convert. I mean, conversion is fine and dandy, and taxpayers with negative taxable income or a low current tax bracket or anything high expected tax bracket in retirement usually tend to try to convert their traditional IRAs to Roths, and they are subject to a current income tax again, and we're basically converting from our traditional to a Roth, so there is some tax involved, not much, but after you're done the conversion, there is no tax on distributions in retirement. Okay, again, that's just to avoid trying being taxed on the traditional distributions when you actually get those payments. That's why it's like a high expected tax bracket in retirement. Okay. Right now, if you're in the low current, because Roth IRAs come after your taxes. Okay, they come after your gross pay, while traditionals come before. That's why they're taxed at distributions, and Roth IRAs are not. Fun stuff. Okay, but no longer a rule that taxpayers must have 100,000 or less in AGI to convert. That used to be a big rule. It stopped a lot of people from doing it. Of course, you make a lot of the population angry. Sometimes things change. Okay. Traditional IRA distributions we have to watch out on. The age limit has been changing, and distributions taxed as ordinary income. You must begin taking distributions by the age of 70 and a half. So, by the time you turn 70 in 6 months, you better start making distributions. Okay? I mean, that's just part of the IRA. There is a 10% penalty if you take the distribution before age of 59 and a half. So that one you have to watch out on, because the IRA is going to know exactly when you took your distribution. They're going to provide a date to the IRS, and if you're at 59.4, well, you still get a 10% penalty. So always have to watch out for that. Okay, this is why we always have to know people's birth dates when we do a tax return. Penalty-free withdrawals from IRAs may be to these taxpayers who are disabled, okay, using special level payment options. That's something worked out with a lot of financial purchases at home for the first time. So you get $10,000 out of your IRA if you're purchasing a home for the first time. Usually that doesn't happen too much anymore, but I mean, we're okay. If you have to pay higher education expenses and using your IRA from there, you can avoid the penalty. Paying for any medical expenses greater than 10% of your AGI or medical insurance premiums for dependents and or unemployment for more than 12 weeks. Okay, those we have to watch out for, but there's also ways. Okay, qualified beneficiaries due to death of the IRA owner. So if you're a qualified person that's going to receive the money, spouse, children, whoever, whatever is in the will, you don't have to pay tax on that money that comes to you. You have some other stuff there, but we're not going to get into those. Paying an IRS levy. So if you owed money to the IRS, you have to take it from your IRA. Well, they don't charge you a penalty because you're already paying a penalty for that levy. Okay, and in qualified reservist, but mostly a lot of times people forget about this 10% penalty. So have to remember that before age 59 and a half, you are subjected to it. Okay, unless you have one of these qualifications, and we do ask for that. Okay, this is also on the retirement 1099 that you get, the 1099-R. So if you haven't seen the 1099-R, let's go find it real quick. So this is a form 1099-R, and that's the red copy. Here's the black copy. Okay, so here they're going to have the same stuff, all the information, and it's going to have Roth, it's going to have date of payment, it's going to even say if there's been any withholding, which you can withhold from these distributions to pay for tax. But it will tell you gross distribution, taxable amount. If it cannot determine the taxable amount, we actually have to determine that. Okay? And it will tell if it's been total distribution. And then for any pension and stuff, it's going to end up telling us right here in the distribution code if it's a normal distribution, if it's death, a lot of other stuff. And this distribution code right here will basically tell us pretty much if there's going to be a penalty or not. Okay? So, Roth IRA distributions. Their qualified distributions are tax-free as long as the Roth IRA was open for 5 years, and again, distribution is made on or after 59 and a half due to a disability, due to a death, or first-time home buyer. Okay, so you have to have this open for 5 years. You can't just open it up at 58 and a half and then have it for 1 year and then it's just like, no, you gotta have it more than 5 years. Okay, if you don't meet the above, part of the distribution will be taxed. Return of capital is tax-free and earning are taxed. So, but you will get taxed if you don't follow these rules. So, 5 years. Have it for 5 years. Alright. So, small businesses and self-employment retirement plans. Again, small businesses could have it. These are internal, the IRC, Internal Revenue Code, does provide federal tax treatment for contributions by or for employees to qualified retirement plans. Okay, this must meet fully funding requirements, comply with fiduciary responsibilities, penalize, prohibit early withdrawals, and some requirement immediately vesting. Vesting just means going into the stock market. Okay, employers get current year deductions for these. This is a benefit to the employer. Employees do not include contributions in income. Okay, and I mean, of course, we're not going to include that. That goes on something else. It's not actually part of our income whatsoever because we didn't actually receive the money. Okay, tax on earnings is deferred until distribution. So, again, you don't pay the tax until you distribute the money at 59 and a half. Okay? So they similar favor IRAs a lot of the ways, and I mean there's so many of those. Okay? Retirement plan options. So as you can see, there's 2 IRAs. Well, all 3 of these are IRAs. So again, you must meet minimum age and years of service requirements. Again, pay an early withdrawal penalty if you do it before 59 and a half. And again, you must start drawing at age 70 and a half. The 3 types that we typically see is the SEP IRA, which is basically a self-employment pension. And it allows tax-free contributions and are limited to lesser of 25% of compensation or net earned income, not to exceed $55,000. Okay, so the max you can contribute, or the max tax-free, is $55,000. Okay, different contribution deductions for employees versus self-employed business owners. Again, that's a lot dealing with a financial planner. Flexible funding is allowed. Yeah, certain stuff right there. Payroll deduction IRA allows employees to pay to be directed into a traditional IRA account. That's what I was already talking about when it comes from gross pay. And then the simple IRA is only available really to employers with 100 or fewer employees. Both employer and employee can contribute with an annual limit of $12,500. $15,500 for taxpayers 50 and older. So again, little age thing, little boost, that catch-up thing going on. So you can have $12,500 in a simple IRA, can be contribute to from both the employee and the employer. Okay, so in you can have about 25K. That's about it, and then it goes up to about 31,000 if everybody maxes it out. Alright, 401Ks. There's a lot of retirement stuff here. Good retirement. So, types of 401Ks that you will see is first the self-employed or solo 401K, and then you have the traditional 401K that comes with businesses with 20 plus. You have known as the safe harbor 401K, and this one immediately has vesting for employer contributions. So immediately it goes into the stock exchange. It's trying to make some money. You have the Roth, which allows the same amounts as traditional, but again, dollars paid in do not reduce employees' taxable income. Okay, so these come after everything's taxed. So 401Ks. Employees choose to defer some of their compensations into plans. Again, this is a deduction we actually choose to put in retirement. So we forgo current compensation basically just so that we can have money in retirement. It's like a savings plan. And the employee chooses how much the percentage is. The amount cannot exceed $18,500 for all salary reduction plans, or $24,500 if over 50. Okay, so even the employer has to watch out for that. You can't take so much. An employer may match to encourage participation. This match is excluded from income. Okay, that's just a benefit. Some employers will do it just because it's like an incentive for the employee to actually put money in retirement. Again, basically if it's coming before taxes are done, this technically saves the employer some money here because they don't have to pay the tax. So when you put money in the 401k, you're saving the employer some tax there. When distributions are occurred though, contributions and earnings are taxable. Remember, 401ks are playing the stock market, so they can earn more money, but it also comes with risk. The Roth in itself came around in 2006, and it allowed employees could defer some annual amount as traditional 401k, but not deductible. Again, it's a non-deductible amount. Withdrawals and earnings generally tax-free upon distribution because they've already been taxed. And they're really good with high income taxpayers because there's no AGI phase out. and much higher annual contribution than a Roth IRA. Okay, so people face, there's so many options in retirement, it is crazy. So, and that, again, that's it with the retirement, by the way. I know it took a long time for that, but there's a lot involved. Again, if you're interested in a retirement, always talk to a financial planner or one that actually deals with retirements, and they'll tell you to straight exactly what you need to do. So, with educator expense and unreimbursed business expenses for performing artists. Okay, these are two little things that end up happening because the TCJA is taking away stuff. They took away some deductions. Here's some that they kept. And one is educators. Okay, they may deduct up to $250 per year for unreimbursed cost of classroom materials. Okay, this is a straight deduction to AGI. Again, one of those things that is called above the line AGI deductions. It is only for K through 12 educators, instructors, counselors, principals, or aides with at least 900 hours per year. Okay, if married and filed jointly, and both of them are educators, of course they get to take double the amount. But we only get $250 for any teacher, which, to be honest, opinion here, it's not enough. Okay, some teachers spend an incredible amount of money, but this is the way it is, and the way it's going to be. So keep an eye on this though, because there was talks about maybe increasing the educators. Okay, unreimbursed employee costs no longer deductible as itemized deductions. Okay, used to be we were able to deduct any unreimbursed employee cost. Now it's done. Okay, can't do it. They're only available for now performing artists, and they have to meet specific qualifications, which we're really not going to get into the qualifications on that. I mean, a lot there. I mean, this law is still changing a lot, so we have to watch out. Okay, National Guard and Reserve members traveling for more than 100 miles away from home can actually use this. Okay, and then fee-based state and local government offices, officials, but it's very limited to everything. So unless they follow in any of those, you're not going to see. Okay. Alright, let me get something to drink. Another big deduction that they took out from above the line that made some people angry is the moving expenses. Before, if you moved and relocated for a new job and you meet the requirements, was about had to be almost 20 miles away or something like that from your previous home, 50, you got to deduct all the moving expenses. Now, the only people that can do that is military. Okay? If you're part of armed forces, you're allowed to deduct any moving of personal items and travel. The only thing you can't deduct is meals, but you can deduct a lot of stuff. Again, everybody else was able to do this, but it got repealed. So sad. So we're not going to really focus too much on this because basically, again, it's really only the expenses to move your personal stuff and travel for anybody in the armed forces. So now we're finally on Schedule A. So here's the Schedule A, and we're going to start off first with medical. Okay, then we're going to get into the taxes and interest and charity, and here's casualty, theft, loss, and other itemized deductions. So we're going to start off with medical. Now, medical expense in itself is any medical that you have to pay for. And this includes prescriptions, doctors, surgeries, eyeglasses, dental, the mileage it took to get there. There's a certain deduction for that. There's a lot of deductions. But, and this one doesn't even show it all. Let me see if I can go, because I really want to show you all the medical deductions, because there are so many. And of course it's not even on here, but it does have interactive tools to help you out. Alright. And this is publication 502, which actually goes over all the medical. But there's a lot of medical stuff that we can deduct, and it is allowed for your spouse, yourself, and dependents, and it's for amounts you can actually deduct when it exceeds 10% of your AGI. Okay, here the item right here is any medical and dental. Enter amount above from Form 1040. Multiply line 2 by 7.5. So right now, in 2018, it is currently 7.5%. It's been 10% for forever, and next year it's going back to 10%. So when we look at Cengage, probably want to use 10%. Okay, don't use the 7.5 unless it specifically tells you. Okay, and this may actually reduce the amount of insurance reimbursement. Okay, so that means you get less of that reimbursement for whatever insurance you paid in, and that's mostly again dealing with ACA. Okay, but we can put medical insurance premiums, long-term care insurance premiums. Again, there's that specific limitations, and if deductions for AGI excluded from Schedule A calculations, but we do have a limit right here on medical. Okay, so gotta watch out for that. The next little part, and more medical right here, more itemized. So as you can see, itemized deductions in excess of 7.5% of AGI. So they actually kind of fix it from right here. But right now it's 7.5. Prescription medicines allowed, special equipment, transportation and lodging for medical care, and even has it right here, it's 18 cents per mile. I know, fun stuff. But transportation for medical care, 18 cents. $50 per night per person lodging deduction. It's basically allowed for a patient and one individual accompanying patient. You can take $50 per night for lodging. Okay, and there is no meal deduction. So you can't take meals, but you can take at least $50 if it's overnight. Okay, so here's an example. Yay! Again, we love examples. So during the year, Frida and Jose paid the following medical expenses: a contact lens, 120, facelift for cosmetic purposes of 2,900, doctor bills, and health insurance premiums. They also traveled 260 miles to see a cardiologist in July. Their gross income is $31,200, and they were reimbursed $1,000 by their insurance. So insurance actually reduces anything that we actually can use. What are the deductible medical dental expenses for the current year? Okay, here we go. Look at the deductions that we can take. 120, 1,600, and 4,800. Okay, we couldn't take the facelift. Cosmetic surgeries are excluded from medical. It doesn't matter if it's been done. You cannot take them. Okay, so they are not deductible. Anything for cosmetic purposes is non-deductible. It's one of the few medical expenses we can't take. Okay, because it wasn't considered an actual medical emergency for most things. Go figure. Okay, so 18 cents times 260 for the miles means we have 6,564. Okay, well, we have a $1,000 reimbursement, so that kicks out 5,567. This is the same thing with the HSA. Okay, so if the HSA, you're taking money from there, basically it's going to deduct from your medical. Okay, so we have the 31,200, which was their AGI, and we're going to times that by 7.5%, or 0.075. With that being said, this means that due to our gross income, we have 2,340 that basically gets taken off because we have to be above that. So since we're above that by 5,567, we're actually allowed to take 3,227 as itemized deduction. So again, as you can see, medical is not all that it's cracked up to be. You can spend a lot of money, but if your AGI is high too, it's not going to help you on deductions. That's one of those little things that they made sure to do. Okay. Now, taxes. There's certain taxes. Okay. So when you look at here, this is the taxes we're looking at, and you're going to have state and local income tax or sales tax, basically, that we can take. And most people will take sales tax. Here in the state of Texas, we get to take sales tax. We tend to use a little bit of AGI and a formula to actually figure this out using our tax rate. We're also allowed to take any local real estate taxes. This is in lieu of them being on the home office. Then you have the certain percentage, but we're allowed to take any real estate taxes. Okay, state and local personal property taxes, in case we have those, and even registration on a car. That's technically a tax you can take. Okay, you're gonna notice this. We're got a $10,000 limit on this. 5,000 if marrying and filing separately, but usually $10,000. Okay. Always love the limits. Yes. So, taxes are imposed by the government to raise revenue, fees and charges with the direct benefits of person paying. That's how they are saying deductible. That's why we can do car registration. Yay. So, examples of deductible taxes. Of course, is the state and local. Deductible in the year paid, and they're limited to that 10 grand. We can only take up to 10 grand. If itemized and receive refund, must declare as income in subsequent year. Okay. So basically, if we receive a refund from our taxes, we gotta declare them as income. Okay. That's only if we itemize. If we don't itemize, then don't have to worry. Okay. Sales and use tax. You may actually use actual tax or the estimation method. So again, there is a worksheet. Let me see if we can find it. Boom, boom, boom. So again, read the book. Read the book is good. Okay. There's logic. There's taxes, income tax, and sales tax. Let me see. So See if this blows up a little bit better to where y'all can see. No, it doesn't. This looks really cruddy. I'll be honest. So as you can see, even blowing it up, I probably shouldn't have done. But they actually have optional sales tax tables. Again, this depends on which state. They just did not do that good. So we'll do it the better way. Here's the worksheet on itself. So, and it will actually tell you which states that wants you to check into the basis. And I mean, overall, I mean the estimate in itself. Let's see where it says Texas. Okay. And you go no. So some people actually just keep the receipts and they can take the sales tax that they paid for the whole year if they're trying to itemize. A lot of times this is really not hard calculation going on, because mostly we're going to put our 8.25, and you're going to see here, enter your state general sales tax from 2017. We don't have a sales tax. Okay. Did you local impose local general sales tax in 2017? And then you go yes, and it says enter your local general sales tax. Again, let me see if I can blow this up so you can see where I'm reading. Okay. And basically, if your local general sales tax was 2.5, you enter 2.5. If you lived in more than one locality in the same state, enter the instructions. That's basically going to be our sales tax, which is 8.75 or 8.25. Ooh, 8.25%. So, did you enter 0 in line 2? Probably yes. Enter your sales tax rate. And then you're going to multiply so much from somewhere. But usually it's just our AGI times by our rate. Again, not overly difficult in the way that they want it to be. It just wants to be a little bit simple. Okay? And then here's real property, and then here's personal property taxes. The example of non-deductible taxes include estate tax, gift tax, and Social Security and exercise tax. All these taxes have their own little special sections on the 1040. So they do not actually have itemization. So don't worry about that. Okay? So here's an example that we got of the tax deduction. Apparently they're doing, let's hopefully go, this is okay. How much can Colleen take for taxes as an itemized deduction if the following scenarios? First scenario is Colleen amends her 2016 state tax return. So we're doing estate tax, and must pay an additional $843 state income tax in 2018. Breakdown of amount due is $93 in penalty and interest and $750 in state income tax. Her state income tax withholding for the current year is $660. She pays quarterly the estimates as follows: pay $200 each of the on 4/15, 6/15, and 9/15 of the current year, and 1/15 of the next year. 1/15 of the current year paid in fourth quarter estimates from prior year of $155. So how much state income tax? Well, here we go. Okay. Colleen may deduct the actual amounts paid in 2018. Again, limited to $10,000. So she can pay the full amount paid in 2018. No problem. Itemized deduction for SIT is $2,165, and all they did was add everything up. $750 plus $660, $200. So that's the part B right here. So all those Then they're going to add $750 because she paid $750, and then she paid $660. So basically, all they're doing is adding everything up. As long as it's under $10,000, we're good. So note this again: if the taxpayer receives refund in SIT that was deducted in a prior year, the refund is taxable income in the year it's received. But if the taxpayer doesn't itemize, then non-taxable. Okay? Cool little item there. That's only what state income tax. We're in the state of Texas. We don't have one. But it's good to know in case they come from Louisiana, Arkansas, Oklahoma. I think New Mexico has one. I think nearly every state surrounding us has a state income tax. Or just one of the lucky few. Okay? Real estate taxes in itself is any property tax on real estate are deductible, even if it's a second home. If it's rental, it goes to Schedule E. Okay? If paid in the escrow, taxes are deductible when paid. Okay? It's not when the escrow, when you pay into the escrow, it's when it's actually paid. Usually you get a document from the mortgage or even from, you can look it up in property tax when you pay this stuff. Okay? When selling property, you need to allocate based on the number of days that each party owned. Okay? So, if you own if you own the house for so many days, well, you get to allocate the property taxes of such. Again, most mortgage companies will send a 1099 or 1098. They're going to send a 1098 to you with a lot of the property tax, or you can basically ask basically ask the mortgage person how much property tax you paid. If it was an account that's looking it up, we can actually look it up through most of the basically property tax officials. Okay. Mostly this also occurs on settlement charges on closing statements where we can find it. Service fees such as homeowners dues are not deductible. Okay. They're deductible with a home office if they're Schedule C, but not deductible on itemized. They are not considered taxes. Personal property taxes, again, this is tax on anything that's personal. Even, again, dealing with registration, stuff like that. It's only the amount that is based on personal property's value is deductible. Okay. Fees calculated on the basis of weight, the scale fees, are not deductible. Can't do those. But we can do registration. Okay. Alright, so here's another example going on. Now we got Selma without Luis. Okay, has an AGI of 31,300 for 2018. She itemizes her deductions and therefore deducts the allowable amount of tax. So, FIT withholding for the year was 2,150. State was 1,500. Social Security 1,768. Real estate taxes on home were 3,300. Sewer fees are 867, and she pays auto registration of 210. Which of that 180 is based on the value of the auto. Nice. How much may Selma show as itemized deductions for taxes? Well, I can already tell you FIT's gone. That's something that we don't deal with. SIT we use. Social Security we won't. Real estate we'll use. Sewer fees, And then we got auto registration of the 180. Okay, so here we go. Itemized deductions that we can use. Again, there's the 1,500 for SIT, the 3,300 for real estate, and the 180 for auto. Again, based on the value, not on the weight. Okay. So sewer fees, we don't care because that's like homeowner dues. Doesn't really deal too much to us. Alright, so interest. Now we move on Schedule A. Now we're moving on to interest, what deals a lot with home mortgage. Yay! And mostly they pop up on Form 1098. Okay, so with that, interest is the amount paid for use of borrowing funds. Again, we can pay a lot of interest, owner's finance, stuff like that on here. Borrower must be legally liable for the note in order to deduct the interest. Examples of deductible interest include, first off, qualified mortgage interest and points, mortgage interest payment, prepayment penalties, any investment interest except to use to generate tax-exempt interest, but investments in certain things you can. That's owner's finance. Certain interests associated with passive activities. Now, that again is dealing with probably your partnership or rental. We can have a few. We can even have it from the home office, from Schedule C, what we couldn't deduct. Okay. Consumer personal interest. So your interest on loan or stuff like that is non-deductible unless it's related to a business. Okay. Mortgage interest again. Qualified resident interest in mortgage that is deductible is usually used on construction, secure construction, first or second residency, and it limits the loans to $750,000. So again, this is your first or second, basically first house or second house, the main ones that you live into. Homes purchased before December 15, 2017 are grandfathered in, and they get to deduct up to $1 million. So just like Dr. Evil, $1 million. Right. Home equity loans in itself, before the TCJA could deduct their interest, it is now disallowed. So we are not allowed to take a home equity loan interest anymore. Same thing with private mortgage insurance, PMI, right? That is now disallowed. They kicked out both of those. So we can't take those. Unfortunately, they were actually pretty good. But that stuff is no longer needed for us. And private mortgage insurance, the PMI was that percentage of insurance if you couldn't pay the complete down payment of 20%. So that sucks. Interest limits limited to debt at or below fair market value of home. Okay, so again, you gotta watch out on the fair market of your property. Loan origination fees, which are basically called points because they are quoted as percentage points of principal, those are still deductible. Okay, and you gotta watch out again. That $750 is half of only married and filing separately. Okay, if you're married filing separately, you take only half of that. So MFS separate, basically doing it MFS and not MFJ, you have to watch out. There's a lot more deductions that are limited. Okay. Education loan interest. Yes, this is what most of y'all will probably have by the time you got your education done. You will have loans and you get to pay interest. Well, you get to deduct up to $2,500, and for some reason I don't know why they put this in here. I guess because it's interest, but this one's not on the Schedule A. This is one that goes directly to AGI. So this is another one of those known as above the line. This would be like Schedule 1 or 2. Okay. Now they do phase out. So if your AGI is greater than 65,000 or 130,000 marrying filing jointly, guess what? You didn't get to qualify for the interest. It is done. Okay? Loan must be used for qualified higher education expenses. So again, tuition, room and board, and any related expenses. Of course, that's all we do. Wink, wink, nudge, nudge. So make sure it is used for higher education expenses. Here's our investment interest. Back to Schedule A. Again, I don't know why they just put that educational loan interest. Mostly I'm thinking it's just because it's interest. But investment interest is incurred on debt to purchase an investment property. Can only deduct up to the amount of net investment income, such as interest income. Okay? So, can only deduct up to your income. Carrying forward any unused investment interest expense to next year. So, you can't carry forward. Yay! We love that. So, if we get to use all this deduction, as long as it gets to use, we just get basically limited to it. Okay? And this is going to put on Form 4952. Which again, let me show you what the 4952 is. Because it's just nice to show y'all. And for some reason, I like seeing it from the IRS website more than it is on the book, because the book makes it all blurry. Here, this is all of our interest right here. Okay? So, investment interest expense, that's paid during this year. Anything that carried forward lets us know how much it is, and then we actually find the gross income, stuff like that. Okay? Not a too difficult form. It's just another one that we have to file just to prove that we did all the calculations correctly. Okay? Now, there are special rules as to including dividends and capital gains in net investment income. Because of the preferential tax treatment, we can do that. It's just not a lot of people do. Okay? And we can also deduct investment expenses other than interest to get to net investment income. So if there's expenses, you can deduct them. Let's see, and it will be provided. See, there's qualified dividends. Okay, net gain on disposition. Then here's our investment expenses. So there they are. And that's mostly paying a broker or any other items related. Alright. Because I know this video is getting long. We're almost there, guys. Keep with me. Alright, charitable contributions. This is now right here. Gifts to charity. So, as you can see, we're almost done with Schedule A. Charitable contributions in itself are allowed as a deduction. It's really, you can contribute cash or property. So, every time you donate to Goodwill, you want to get the receipt. Just saying that you donated helps out. Okay. Any out-of-pocket expenses to donate or to pay cash or anything like that are deductible. You also have a mileage one. So if you have to travel for a charitable event or stuff like that, you get 14 cents per mile. And the value of the free use of taxpayers' property is not deductible. Okay? You can't deduct free one. But if you donate your service, you can show that it is deductible. Okay? And to be deductible, donations must be made to qualified recipients. This mostly, I can tell you real quick, even before looking into this, is that mostly it's a 503c, which is any non-profit charitable. So, right here, investment, charitable. So, they have to follow these. So, must be the United States state public or therefore, if the donation is made for exclusive public purposes. Must be domestic organizations, formed exclusively for charitable, religious, educational, scientific, leadership, or prevention of cruelty to animals or children. Okay? A church. And yes, putting money in the little donation item, as long as you can kind of guess how much you put in, you can deduct, even if you don't have a receipt. Okay, war veterans organizations, civil defense organizations, fraternal societies operating under the lodge system, okay, can take it, but only if the contribution is used for one or more of the charitable purposes listed in 2 above, so up here. Okay, certain nonprofit cemeteries, but here's stuff that is not. Okay, so not deductible. Gifts to non-qualified recipients. This includes needy individuals, social clubs, labor unions, international organizations, and political parties. Definitely big old political parties. People try and deduct that all the time, but that just does not work. Okay. Now this says contributions of time, service, the use of property, or blood. Yeah, you can't deduct your blood. Okay. Sorry guys, it doesn't happen. But those are certain things. Contributions where benefit is received from the contribution. For example, tuitions at Paralympic school. I mean, if you buy Girl Scout cookies, well, yeah, you're donating to a non-profit, but you got benefit from it for the Girl Scout cookies. So, it doesn't work. And wagering losses such as church bingo or raffle tickets. Okay, anything that deals with something that you could have won something. Okay, now, we always want to watch out on these. That's a lot of stuff. Okay. And then, of course, the IRS also publishes an online search tool called Exempt Organization Select Check. All exempt organizations have to be under this. Okay. So if you want to check just to make sure it follows and we can get a deductible, then you can just put it through this and they'll find it. Okay. Now, property. Gifts of household items, clothing are now subjected to new requirements. They must be in good condition, which the IRS, not the IRS, the Goodwill or Salvation Army will let you know if they can resell it. It's in good condition to them. Okay, items with minimum value may not be deducted. With minimum value, if contributed property, this deduction is equal to fair market value at time of donation. Okay, so that's anything of basically buildings and stuff like that. And the exception is if the donated property would have resulted in ordinary income or short-term capital gain. Then we deduct the fair market value less the amount of value of ordinary income or ST, short-term capital gain, that would have resulted. So they do put a limit on that. Okay. The other contribution, if taxpayers donate appreciated long-term capital gain property such as appreciated stock, may deduct the fair market value of property except if donation made to certain private non-operating foundations, they can only deduct fair market value minus potential capital gain. Or the donation is contribute to tangible personal property to organizations that use it for purposes unrelated to their primary purpose. And this includes such as artwork contribute to the Humane Society. Okay, it's not working with the organization's primary purpose, so you will have to take the long-term capital gain basically subtracted from your fair market value. Okay, so good tax planning tip. Yay, we love it when they do this. Full deduction taken for appreciated property and tax avoided on appreciation right here. So we may get to deduct again on that as long as it doesn't fall under one of these exceptions. Okay, so here we go. Just because it wants to show you out how it goes. B donates an antique couch to a nonprofit that provides housing items to battered women. The couch cost $2,500 and is now worth $4,000. Awesome. How much may B deduct for contributions? Would B's deduction change if she had donated the couch to an environmental organization? So with this, since she sold the antique, her long-term capital gain would have been $1,500. Since the couch is put to use related to the organization's primary purpose with battered women, because it does need furniture, we get to deduct the full $4,000, which is good. Okay. If the antique was donated to an environmental organization, the purpose is unrelated. Environmental organization don't care about no couch. It's not to their purpose, and therefore must be reduced her deduction by the amount of LTCJ. Okay, that would have resulted if the item has been sold. Thus, sold at, basically the deduction is the original purchase price. Okay, which is funny. It really is, because it cost us $2,500. That's the minimum you get to deduct. Okay, it can appreciate. Okay, so there is certain percentage limitations, and generally deductions for charitable contributions are limited to 50% of the taxpayer's AGI. So now we got 50% to deal with. A lot of limits on that itemized. Okay, this applies to donations to any and all public charities and all private organizations, foundations, and specific private non-operating foundations. 50% of organizations really do include churches and educational insurance. So we are limited 50%. Okay. TCJA increased the percentage to 60% for cash donations. So if it's property, 50%. Cash, 60%. Yay, TCJA, trying to help us to make more donations. Okay. 30% organizations. Now these include fraternal societies and veteran organizations. They're also private non-operating foundations. Okay. And it also marks this little star. The TCJA change is this allowance of deductions for payments to colleges and universities in exchange for the right to purchase tickets, sittings at an athletic event. So I automatically would tell you that should be disallowed because that's a benefit. But they're just making sure that you know about colleges, universities on purchasing tickets. Alright, we're almost there, guys. There's 55 slides, we're at 48. Okay, contributions on substantiation. Okay, there is no deduction allowed for contributions of $250 plus unless there's a written substant. Okay, so basically you have to have documentation that says that you've donated. Okay. Clothing and household items must be in good conditions or better to qualify for the deduction. Again, that's all up to Salvation Army, the thrift store, or whoever you donated it to, as long as it's one of those charities, the church itself. Okay. If the charity knowingly provides false acknowledgement, that charity gets a penalty of $1,000. So this makes charities want to actually say the right thing. Okay. And then quid pro quo contributions is partly a gift, partly consideration, and those tend to be non-deductible, but again, we'll have when disclosures must be given to donors stating the good faith estimate of goods services received. Okay, what they think the fair market value is. Like vehicles in itself. When we donate a vehicle, it's basically how much the charity gets to sell that vehicle is our limit on our deduction. So, and it applies to boats and planes. Yay! Charitable organization sends the form 1098-C when they resell info. Okay, we are not allowed to deduct it until we get that 1098-C if we do a vehicle, boat, or plane. Okay. Now, taxpayer may claim estimated value if charitable uses donated auto rather than selling it, or donates it to a needy individual. So if a charity donates it or uses it, we get to use an estimated value. Okay? Basically, fair market value is our estimate, Kelly's Blue Book. But if it's the purpose of them selling it, we have to wait for that 1098-C. So you gotta know how the charitable is going to do it. Alright, so charitable contributions. Example: during the current year, Clem donates $1,260 to his synagogue youth group. Allows the youth group to use his lake cabin, valued at $500. Drives 1,000 miles on behalf of the YWCA. And donates a vehicle valued at $950 to the Bower Women's Shelter. The shelter sells the auto for $750 and issues out the 1098-C. To Clem, what is Clem's charitable contribution deduction? Woo, lots of stuff. Okay, so first thing off, the lake cabin we know is no good. We know also that we can only deduct up to the sale of the vehicle. So only that $750. Well, he did drive 1,000 miles, so we get to times that by the 14-cent rule. We get to add the 1,260 right there. And we also add 750, so his total contribute deduction is 2,150. Okay? So the only thing to watch out is property and how it's used. We cannot take personal property. Can never take that as a donation, and we gotta watch out on vehicle sales. Alright. So casualty and theft losses. Here we go. This is back when Hurricane Harvey hit. If you lost anything, you had a casualty and theft loss. So you experienced some of this already. If not, mostly this happens when something really bad happens. Okay? Prior to the TCJA, deductions were allowed for casualty and theft losses to be itemized deduction from AGI, or if it's business related, deducted for AGI. Okay? So, if it was business related, the Schedule C, we were able to deduct it right directly to AGI. If it was itemized, basically personal stuff, our house, it was deducted like directed deduction from AGI, or basically itemized. Okay. To be classified as a casualty loss, event needs to be sudden, unexpected, or unusual. So again, natural disasters is a big one. Theft is also big, but it needs to be proven. So anytime you have a theft, have that police report. Okay, and the difference is calculations for deduction based on the type of property in itself. So we're going to look mostly at fair market value and how much insurance is covered. So we'll probably get into a lot of those items right there. Since the TCJA, personal casualty losses are only deductible in federal declared disaster areas. Okay, so now since the new law, we can't take personal stuff unless it's in a declared disaster area. And we must subtract $100 floor and must exceed 10% of our AGI to be declared. So they really limited this one. So it kind of sucked. But we actually, it's really only really supposed to have been used for any natural disaster or anything that was really sudden. So taxpayers that do not itemize were permitted in 2017 to add qualified federal disaster area loss to standard deduction. So you got a little boost for Harvey, but really they try to watch out too much about that. Okay, there's not a lot that we can take now for it. Okay, and the book does go into a lot of the casualty loss. So go into casualty. Oh. So it does talk about how to measure the loss, and deduction of base. There's actually two, A and B. The amount of casualty left is measured by rule A. The deduction is based on the increase in fair market value of the property, not to exceed the adjusted base of the property. So basically, the fair market value, if it's decreased, that's our deduction. Or the deduction is based on the adjusted basis of the property, how much it changed. Okay, so, and it goes through how it's loss of automobile damage, repair, and repair work is typically the one that we typically use with the rule A. Okay, and again, here's the deduction limits, a couple examples. So they don't go heavily deep because it's been limited to a little bit too much. Okay, here we go. Some miscellaneous deductions to finish things off in this long video. Sorry guys, try and get you all. Okay, miscellaneous deductions. There are two types of miscellaneous deductions. Those with no limits. Okay, and those with no limits include handicapped, impaired related work expenses, certain estate taxes that we may get into, amortization bond premium. Okay, so this is bonds purchased prior to '86, basically. Gambling losses to extent of gambling winnings. So there, you can only take losses up to the amount that you won. Unrecovered annuity costs at death. So again, something dealing with the state taxes. Those that are limited to amount over 2% AGI. Okay, these were basically suspended by the TCJA, which that bites. Again, includes. I mean, these were actually include unreimbursed employee business expenses, which they got rid of, investment expenses, tax preparer fees, union dues, etc. There are so many. Let's see. These are unreimbursed employee expenses are included in the following list. Then here's the ones that actually get to have everything. So miscellaneous item deductions not subjected to 2% floor. Okay, well, sorry, this is going to be kind of cut into two. Apparently the recording software stopped right here. So basically what we're going to have right here is the book shows all the losses. So there's extra losses that we actually have, which includes losses from a Ponzi scheme and other items. So always good to look at the books. So again, we're looking at basically the phase out of our suspension of these deductions that are above 2%. And again, this includes the investment expense, which is fees paid to brokers to acquire stocks and bonds. These are not deductible in any way because they're already deducted into our Schedule D when we look at cost basis of stocks and bonds. Okay, so investment expenses were deductions allowed directly related to taxable income. Okay, again, tax preparer fees we got to deduct, and job hunting expenses if seeking a job in current trade can deduct, or if unemployed there has been no gap since last job. We got to deduct these, but TCJA has suspended them. again, they would have to be, their toll would have to be over 2% of our AGI. So the last little part that we have is something that was a phase out that has been repealed by the TCJA, as you can see right here. But before then, so before this year, there was actually a limit on your itemized to the high income. So if their AGI was in excess of 261,500, if they're found single or head of household at 287,000, married found jointly 313, or married found separately 156. Anything that was above that would again be times by 3% of the excess of taxpayer AGI and be basically taken away from their itemized. So we had to watch out for that with high income people, but that doesn't follow in line with most Americans. Or 80% of their itemized deductions can be used other than medical expenses, investment interest, casualty theft, wagering losses that are in excess of wagering gains. Those weren't allowed, but you get 80%. So sometimes that worked. They had a choice, but because the TCJA has basically knocked it out, we don't have to worry too much about it. So guys, that's it for Chapter 5 and dealing with itemized deductions and deductions above the line that are for AGI, not from AGI. So that's it, this long road. So if you watch this for the whole entire time and you got a bit confused, you can definitely put a comment there down for the video or email me a question. I'll make sure to answer it. But this war of taxes is still going on for us, and we'll get into more items. But this is your tour guide on this adventure that we've weaved. Professor Naragon signing off.